Bitcoin breaking a little bit above 27,000 earlier today. We have a battle between the bond market and the stock market over what the Fed's move will be next. And what does that mean for crypto? Well, joining us now to discuss is Managing Director and Chief Market Strategist at Bannockburn Global Forex, Marc Chandler. He also has an incredible newsletter, Marc to Market. Marc, welcome back.
Thanks. Always a pleasure to be here.
Glad to see you again. You know, as I mentioned before, we have the bond market seems to agree with the Fed, at least for the time being. We'll see how things go this week. But so far, it seems to agree that the Fed is, in fact, just doing essentially a pause, or rather a skip. That, in other words, they're going to raise rates a couple of times, 25 basis points before the end of the year. They're not going to cut rates. So far, it seems, at least last week, that the bond market thinks the Fed has some credibility. The stock market, not the same thing. Stock market thinks that it's a pause, indefinite pause, and that, in fact, perhaps the Fed might cut rates before the end of the year. And yet we see crypto now, we see Bitcoin particularly getting close to 27, taking on that risk. It seems to be swaying towards the stock market's narrative that the Fed is going to stop raising rates. What do you think is going on?
Yeah, I find crypto very difficult right now. And last time we talked, we were talking about some of the correlations between Bitcoin and the stock market, risk assets in general. I think that correlation is broken down. To me, Bitcoin's been trading lower basically for the last 2 months, since middle of April. I think you're right. We're coming up against this 2,700 level. I've got the downtrend from mid-April coming in around 27,300, and a break above that tells me maybe 28,500. But I don't think that crypto is really being fueled by this tension you see between the stock market and the bond market. I think that earlier this year the market was pricing in 3 Fed rate cuts, and the Fed pushed against it, and gradually, begrudgingly, the market converged with the Fed. And now the Fed says, no, we're going to hike rates 2 more times, and the market's not quite there yet. I don't know about how the long end of the curve is really tied to the short end, but at the short end, in the Fed funds futures market, I'd say the market's not even pricing in one of the 2 hikes that the Fed is saying. Stock market, different story. I don't think that it takes a Fed rate cut to fuel the stock market, anticipation of a rate cut to fuel the stock market. I think that the market tends to react differently to the first rate hike in a cycle than to the last hike. And when the Fed raises rates 1 more time or 2 more times, like it says, the market knows the Fed is just about done raising rates, or thinks it's almost done raising rates. And I think that's what's helping stock market. And just today, we saw this incredible number that I think is going to fuel these Fed comments. Between today and the end of the week, we have over half the Fed officials speaking. We saw a 21% jump in housing starts. And this is just going to just fuel this idea that Fed argues that demand is running stronger than supply.
Well, yeah, and it actually ties in with higher interest rates, right? And that's something that the home builders have been saying, is that they're finding it to be a boom time for them because interest rates are so high. Mortgage rates have gone up so fast and so high that sellers aren't in the market anymore because they're locked into these low rates that they got at, something like 85% of all mortgage holders have mortgages under 5%. And now we're at 7.25, 7.5 in mortgage rates. People are reluctant to sell because then they have to refinance, or they have to buy a new house at a high rate. And for home builders, they're taking in the market of demand. So I think we see that kind of skew happen on the macro level. But as what you said about the bond market not pricing in right now, or at least before, they did price in a couple of rate hikes along with the dot plots. But what I'm wondering is this: do you think that the Fed, looking at this, says, look, we got to keep credibility here? We've kind of hinted we're going to do 2 more rate hikes before the end of the year. We've got to show the market we mean business. Otherwise, they'll never take us seriously. Do you think that the Fed will plow ahead and just do it anyway, regardless of what the stock market thinks, or maybe now a little bit more the bond market? And they'll just say, look, we're just going to do what we said we're going to do just because we have to. Otherwise, anything we do in the future goes out the window.
Yeah, I think when I can try to get my head around what the Fed thinks, sort of the Fed's reaction function, I don't put, barring a big instability move, sort of multi-sigma move in the stocks or bonds, I don't think that that's important for the Federal Reserve. I'll tell you what I think the Federal Reserve is watching. Next week, we're going to get personal consumption and income levels and a deflator. And what we're going to see is that the headline deflator is going to be running about half the pace. So in the first 5 months of the year, it'll be running about half the pace that we saw in the first 5 months of last year. However, the core measure of PCE, and the reason the Fed, I should say, looks at the core rate, and the reason economists do, is not because food and energy are volatile or that they're driven by supply functions. But more, the real reason, I think, is that over time, what we've learned is that the headline rate converges to the core rate, rather than the core rate converging to the headline rate. And so the high, sticky core rate is problematic. And we're going to see when we get those data next week is that there's been really no improvement in the pace of the core rate rising in the first 5 months of this year compared to the first 5 months of last year. And that's what I think many of the Fed officials are going to say. They're just not seeing improvement on the core rate of inflation. And that is troublesome for them. And that's why I think they want to raise rates. I don't think it's simply because of their credibility, sort of slow to begin tightening, slow to end QE. I think it's because of what they're looking at, sticky core inflation, and that they think is the future of headline inflation.
All right, let's move east. At the top of the show, we spoke a little bit about China, and some are saying that a bigger China stimulus could eventually push risk assets higher. What are your thoughts here?
Yeah, it's funny. We talk about the Fed raising rates 25 basis points. Earlier, they raised rates 75 basis points. And what did the Chinese have done in the last couple of weeks? They cut some benchmark rates by 10 basis points. It's not very inspiring. And I think one of the reasons why the Chinese stocks have sold off, and today in particular, but generally underperformed, is the market is waiting for Beijing to provide fresh stimulus to underpin the economy. The economy is likely to go faster than the U.S., go faster than most of the major countries this year as it comes out of the COVID. We're talking about roughly 5%. I know some banks have revised down their forecasts a little bit, but we're still talking about relatively strong growth compared to many other countries in the world. But it's not good enough for China, especially given the other constraints they have coming from the property market. And so generally speaking, I think that this is what we're holding back for. But on the other hand, here's what I sort of see happening. The U.S., many of the other industrialized countries, raising interest rates, tightening fiscal policies. And what is China doing? They're easing policy. So which stock market do you want to be in? Which stock market you think would be a better performer? The markets in which the policy is tightening or where policy is easing? So my inclination really is that Chinese stocks undervalued here, and that can take away some of the speculative capital that's gone other places.
Marc, thank you very much for joining us this morning. It's always a pleasure having you on the show.
Thank you. Good luck to everybody.
You too.
That was the Managing Director and Chief Market Strategist at Bannockburn Global Forex, Marc Chandler.